You're listening to What the Sigma with Chad Stacks. Today on the show, Anthropic just filed for its IPO and beat OpenAI to the public markets, which means the entire AI sector is about to get valued against Claude's $965 billion price tag, a number that nearly tripled in 3 months while the company's keeping its actual losses hidden from investors until launch day. We're breaking down why going first is such a power move, how this changes everything for OpenAI's IPO plans, and the billion-dollar weapons targeting controversy that could torpedo Anthropic's defense contracts before it even goes public. Anthropic's valuation went from $380 billion to $965 billion in roughly 3 months. Revenue in the same window went from $30 billion annualized to $47 billion. The valuation re-rated 2.5 times. The revenue line moved 1.5 times. And Anthropic just filed confidentially with the SEC, which means that gap between the private market multiple and the fundamentals that supposedly justify it gets locked in before a single line of the S1 reaches public daylight. That is the story, not the headline number, the ratio. Let me build this out properly, because the sequencing here matters more than most coverage is acknowledging. Anthropic was founded a few years ago by ex-OpenAI employees who left over safety disagreements. It has spent most of its existence as the thoughtful underdog in a race dominated by OpenAI's brand and Microsoft's capital. Then, in a span of weeks, it closes a $65 billion Series H, co-led by Altimeter, Dragoneer, Green Oaks, Sequoia, Capital Group, Coatue, and D1. Prints a $965 billion post-money valuation, announces $47 billion in annualized revenue, launches Claude Opus 4.8, and files a confidential S1 with the SEC. That is a lot of surface area for 1 month. Patrick Corrigan, a law professor at Notre Dame, said it plainly. Everyone was expecting OpenAI to go first. OpenAI did not go first. Anthropic did. And Corrigan's follow-on point is the one worth sitting with. He said there seems to be a first-mover advantage here because public investors are going to be comparing these companies at roughly the same time. That is not a minor observation. Whoever prices first sets the comp. Whatever multiple Anthropic prints, OpenAI gets benchmarked against it. OpenAI is currently sitting at an $852 billion post-money valuation after raising $122 billion earlier this year. It is also carrying disclosed missed revenue targets, a court fight with Elon Musk, and what multiple sources describe as investor unease. Anthropic just handed its rival the worst possible gift, a higher multiple comparable that OpenAI now has to either beat or defend against, while its own house is not fully in order. SpaceX post-xAI merger is the ceiling in this race. It filed confidentially in April, published its IPO filing on May 20th, and according to one report, is targeting a June 12th debut with a valuation in the $1.75 to $1.8 trillion range. There is a source conflict worth flagging. One outlet pegs the current post-merger mark at $1.25 trillion, while others cite the IPO target at $1.75 to $1.8 trillion. No source explicitly reconciles these. The most likely read is that $1.25 trillion is the current secondary mark, and $1.75 trillion is where Musk wants to print. Either way, SpaceX sets the absolute ceiling for this cycle's AI and tech IPO pricing. Now, here is what is actually real about the Anthropic move, and I want to be specific about this because the coverage is underplaying it. The Mythos situation is not just a product story. According to one report, Anthropic previewed its Mythos model in April and has deliberately declined to release it broadly. Instead, it is being gated through something called Project Glasswing, a controlled deployment with Apple, Microsoft, Google, AWS, CrowdStrike, Palo Alto Networks, and roughly 40 other organizations. That is a revenue vector the public cannot price because it is not public. The framing conflict between sources is interesting here. One outlet reads Mythos as a near-term revenue accelerant, something that could push the $47 billion ARR line higher as availability widens. Another frames the gating as deliberate, safety-driven, and structural. Those two readings imply meaningfully different IPO narratives. One says the revenue growth rate is about to accelerate. The other says the ceiling is intentional. We will come back to what that distinction means for the valuation math. Claude Code is also worth naming directly. Multiple sources describe it as widely considered best-in-class for enterprise coding assistance. That is a specific competitive position in a category where OpenAI's Codex and Google's tooling are both well-funded. Best-in-class in enterprise code is not a marketing claim right now, it is a revenue moat, and it feeds the $47 billion ARR figure in ways the headline does not break out. No source tells us how much of that $47 billion is Claude code versus general API versus consumer Claude. That breakdown, when the S1 eventually goes public, will be one of the most important lines in the document. Now, the things the coverage is not telling you. First, losses. Every article acknowledges Anthropic is losing more than it makes. Not one cites a dollar figure. For a company with $47 billion in annualized revenue, filing what could be the largest IPO in history, the burn rate is the story, and no one has it. The compute cost structure is similarly invisible. One outlet mentions cloud computing and thousands of staff as the cost drivers, but no source breaks out AWS spend, training costs, or unit economics. This matters specifically because Amazon is both a large Anthropic shareholder and its primary cloud vendor. That is a related party relationship that will require disclosure in the S1, and the conflict of interest is structural. Amazon is incentivized to price Anthropic's cloud contracts in ways that serve Amazon's equity position, not necessarily in ways that maximize Anthropic's margins. When the S1 drops, the Amazon section is the first thing a sharp analyst reads. Second risk that is being underplayed. Pete Hegseth invoked 2 supply chain laws to sanction Anthropic and remove Claude from federal agencies. Anthropic is suing. According to Anthropic's own executives, the sanctions could cost them billions of dollars in sales this year. That is a disclosed material risk sitting inside a confidential filing the public cannot read. The number is not in any source, the breakdown by agency and contract is not in any source, and none of the 6 articles I reviewed engages seriously with what a multi-billion-dollar federal revenue hole means for a company trying to defend a near-trillion-dollar valuation. If your own executives are quantifying the damage in billions and you are filing an S1 in the same week, what exactly does the risk factor section look like? Third, governance. One outlet, and only one, flags that Anthropic's public benefit corporation structure and its long-term benefit trust could cause delays and a knockdown in valuation. No source quantifies this or explores the mechanism. If the LTBT forces a snap-style non-voting share class, you get index inclusion friction, you get institutional ownership limits, and you get a structural valuation discount that does not show up in the ARR headline. The silence on this, across 6 articles covering a near trillion-dollar IPO filing, is notable. One more item, because it belongs in the record. According to one report, the secondary market for Anthropic exposure has been running a fraud problem. 3 New York brokers pleaded guilty after raising $185 million from more than 1,000 investors selling Anthropic shadow exposure through a 3-layer SPV stack where a $10 million investment could lose roughly $5 million to fees and structure before it ever touched Anthropic equity. As the IPO clock starts, that secondary market shadow exposure has to be reconciled. Expect more enforcement in this window, not less. The Axios piece flagged as Anthropic faces AI spending backlash before IPO was inaccessible. The headline alone suggests enterprise customers are pushing back on AI cost. None of the other 6 sources engage with this directly, despite it being directly adjacent to the IPO marketing window. That gap is worth noting because if enterprise spend is softening, it is the single most direct challenge to the $47 billion ARR trajectory that the $965 billion valuation is built on. Here is the actual read. Anthropic is a genuinely strong company. The Claude code position is real, the Glasswing partner roster is real, the revenue trajectory is real. The first mover IPO sequencing is a sharp strategic move, and Dario Amodei deserves credit for the timing. But the valuation re-rated 2.5 times on 1.5 times the revenue in 3 months, and the confidential filing mechanism exists precisely to prevent public scrutiny from compressing that gap before the roadshow. When the S1 eventually drops, the lines that matter are not the ARR headline. They are the net loss, the Amazon-related party disclosures, the LTBT governance structure, and the federal contract exposure. The company that sets the AI IPO comp is not necessarily the company that survives the comp it sets. What the Sigma? Follow our show if you want the alpha before everyone else. Nothing here is financial advice.
Grab news. Thomas.